Hey guys, today we're going to be talking about inflation over the next decade, what is going to happen, as well as the bond yields, the 10-year treasury, and how it's going to affect you and I, how it's going to affect the real estate market, how it's going to affect the stock market. And then at the end, we are going to give some takeaways on how you can prepare. This is the first video of a two-part series. The second video, we're going to talk about how this is going to impact the coming Great Depression and when it's going to happen, why it's going to happen, and how to prepare. Let's jump in. Let's start talking about inflation. Okay, high level, inflation is pushing towards 3%. Now, when I say inflation, I'm talking about the CPI number. I call this the CPI number because it doesn't factor in food, energy, mortgage, and rent, which is what we spend half of our money on. Right now, inflation is in the twos. It's pushing towards 3, but we anticipate that inflation is going to actually peak around 7% by 2032. And then it's going to begin to come down into that 2% range. Now, there's 5 reasons why. The first reason why is we are shifting from globalization to nationalization. What does this mean? In the 80s and 90s, we were globalizing. We were using other countries to import, export. Things were getting cheaper. We were leveraging our strengths as countries to help bring down the costs of goods and services. Well, with Trump, he's recognized that over the last handful of decades, there's been a lot of manipulation as well as, frankly, ripping off America with the trade game. And that's why he has proposed implementing tariffs. The problem is as we go more nationalized, as we nationalize our dependency on goods and services, bringing it more in-house and taking care of our needs here in the United States, there are certain things that become more expensive, which can be inflationary by nature. I'll give you a great example. Did you know that this iPhone over in China only costs $10 to make? If we bring this over to the United States to build, it would make the cost of buying the iPhone somewhere between $5,000 and $10,000. That's the trade-off for nationalization. Yes, we don't depend on China or Vietnam to build our phones, but it's going to cost 5 to 10 times more. The second reason why inflation is going to go up is persistent government deficits and debt monetization. What does that mean? What happens when the government needs to sell bonds to fund its expenditures, right? All these things we're spending money on, is central banks like the Federal Reserve will buy the treasuries. And when you buy the treasuries, it's what's called quantitative easing. In other words, it's a fancy way of printing money. We all know this. When you print money, inflation occurs. As the debt grows and we need more money to pay the interest, we need more money to pay Social Security and Medicare and all of our unfunded liabilities, the Federal Reserve buys the treasuries with printed money and inflation occurs again. The third reason why inflation is going to continue to go up through 2032 is increasing insurance premiums. Now, some of you guys have experienced this personally. Even if you don't live in Florida or California, where these natural disasters seem to be wiping out entire communities, your insurance premiums may have actually gone up because the state farms or the progressives of the world are taking a beating on property and casualty insurance, and they're having to raise prices across the board. If you happen to be in one of those states where they're experiencing a lot of natural disasters, a lot of these insurance companies are pulling out altogether. And if you do happen to be one of the lucky few that has insurance in those states, often they've increased by 5x just to cover your home or flood insurance or hurricane insurance, fire insurance. It's very, very expensive, and this obviously makes the cost of living continue to go up. It's inflationary. The fourth reason is rising healthcare costs. It's estimated by 2028 that the total healthcare costs is going to be $8 trillion. Now we only bring in 5 trillion in tax revenue, 8 trillion for healthcare costs. As the baby boomers are aging, it's getting more and more expensive to take care of healthcare. This is going to have an impact. A lot of Medicare Advantage and Medicare supplement plans are having to adjust their premiums because overall healthcare is getting a lot more expensive. Fifth and finally, currency depreciation. As we deficit spend, as we spend $1 to $2 trillion more per year than we bring in, there's more dollars going into the global system. And when you have more dollars going into the global system, it weakens the dollar's purchasing power. So all of a sudden, a carton of eggs used to be $3, now it's $5 or $6. There's too many dollars chasing too few goods and services, and this is going to only increase over the next 7 years. We anticipate, like I said, that we are going to peak in 2032. Now, if inflation's going up, then what the heck is going to happen to the 10-year treasury? What's going to happen to interest rates? Let's talk about that. We believe that the 10-year treasury, which is the benchmark for everything, our entire society, really the global society, runs off of the 10-year treasury. What the 10-year treasury does is it affects CDs, annuities, money markets, high yield savings, mortgage rates, credit cards. It affects the stock market. It affects absolutely everything. Remember, the goal of the Federal Reserve is to keep inflation low. I don't know if you remember, but in 2021, where the CPI number got up to 9%, when it got up to 9%, what did the Federal Reserve do? They raised rates. And all of a sudden, the cost of borrowing got more expensive. It was more and more difficult to get a mortgage. The CDs and high yield savings rates went up. Annuities got more competitive. Everything changed when rates went up. But here's the problem. Right now, the 10-year treasury is about 4.5%. We anticipate that this is going to peak in 2030 at 8%. Now, this is really great for CDs, money markets, annuities. That's really great. I'll tell you where it's not great is the real estate market, is the stock market. The reason why is because the real estate market, everything is based upon how much can you afford monthly. You're going to go get a house, and the first thing that the loan officer is going to ask, how much do you think you can afford monthly? The way that mortgages work based upon the 10-year treasury is if the 10-year treasury is at 4.5%, the bank that's selling you the mortgage is going to charge 2.5% to 3% more. That's their spread. So if the 10-year treasury is 4.5%, your mortgage on this house you want is going to be around 7%. What happens if rates get up to 8%? That means a mortgage is now going to cost 10.5% to 11%. Now, historically, that's normal. But the last couple decades, we're not used to that. We're used to very low rates, 2%, 3% rates. And so for it to go up to 10.5 and 11, that means that the real estate market is going to get wiped out. It's going to get really hurt. Additionally, you look at these big companies in the S&P 500, they all have debt and they're all commercial debt. It's variable rates. So if the cost of their debt doubles, what does that do to their profit margin? How does that affect their stock? The two main reasons why the 10-year treasury is going to hit 8% by 2030 is because the bond yield has to rise. The 10-year treasury has to go up in order for the Federal Reserve to combat this rising inflation. That is going to stagnate or slow the growth in the economy. The second reason why the 10-year treasury has to go up is there's falling foreign demand. All of these countries like China and Japan and the oil exporters are ditching the United States dollar and they're going to gold, they're going to yuan, they're going to the euro because they're losing faith and trust in our ability to pay it back. And when foreign investors are not investing in the 10-year treasury, which is how we get the money to pay for all these stupid things that we pay for, then that means that the bond yield has to go up in order to attract domestic buyers like you and me in order to fund this whole system. Now we have some takeaways. I've got 4 takeaways for you in light of this. The first takeaway is don't have any variable debt. And if you have variable debt, get it fixed right now. If you have an office or if you have a commercial property or some sort of variable debt, fix the rate now while you can, because it's going to be high for the next 10 years or so. Number 2, if you're going to buy or sell real estate, now is the time to do so. And if you're buying real estate, you better have a long-term time horizon where you don't need to sell for the next decade, because you may not retain the value that you purchased it for 10 or 12 years. The third thing that you're going to want to do is have cash. If you can stack up cash, you're going to be able to buy properties for a fire sale. That's going to be super helpful in the coming age, in the coming decade. Have cash. If you have cash, you will have your pick of the litter. It'll be like buying real estate in 2009 or 2010, which have quadrupled or more in value since then. We are going to repeat that. And if you have cash, you're going to be very well situated for what's coming. And number 4, this is absolutely important, is you have to know when to play offense and when to play defense in the stock market. And we're going to talk about in our next video when to play offense and when to play defense in light of the coming Great Depression. If you'd like to learn more and you want to watch that video and know how the interest rates and the 10-year treasury is going to affect the next Great Depression, you're going to want to click on the link below.